Good afternoon. And just like Jordan, I hope you had your afternoon coffee. Very important now. Now there's a couple more sessions coming up. I did a session earlier and still feeling excited, so that's good. Coffee's still hitting. So yeah, so as Jordan mentioned, we're going to be talking about I'm going to be talking about maximizing efficiency and control and in-house banking solutions. So I'm in the in-house banking, right? In-house banking has been a hot topic these days because of all of the, of course, advantages for in-house banking, and more companies can do it, right? And we'll go over different types and the goods and the bads. Before we start, I just want to introduce myself. My name is Abdel Saafan. I'm a SaaS Treasury practice lead here at Elire. So I manage SaaS Treasury practice, implementing a slew of TMSs, ERPs, and also providing advisory services for our clients. So we're basically I'm a trusted advisor for the clients with ongoing relationships, and I utilize my experience in certifications and risk and hedge accounting and all other modules to assist clients with with best practices. So we're going to go over this agenda here. Introduction, I'm going to talk about a little bit. What is in-house banking? What in-house banking looks like, benefits of in-house banking, and efficiency and risk mitigation. And then we're going to have some time towards the end for some Q&A. So a little introduction and industry experience. So you see in this beautiful slide here, Elire was founded back in 2005, right? And it was based on founding partners' expertise in treasury space. Okay. So started off as treasury, and it grew with a multifaceted company. Right? And we do much more, and I'm going to show this in the next slide. But since then, we've implemented over 250 Treasury workstation implementation and advisory projects. And like I said before with myself, but also there as a whole, our goal is to be a trusted advisor to our clients, right? To build that trust, supporting the people, processes, and the systems that make their business successful. So here are the services that we provide. And it's great services, just to start, the great services that Elire provides here. Oracle Cloud, PeopleSoft, EPM Analytics, which is new actually, because Elire newly acquired EPM Analytics with acquisition of Centralize. So this is on-prem and cloud EPM platforms, planning and budgeting, closing consolidation, account reconciliation, and reporting. In addition, of course, to analytics. Okay. So moving on, Treasury is, of course, another service that Elire provides, and one of the fastest growing practices here at Elire. SaaS Treasury, and just going through SaaS Treasury would be the Kyriba, for example, TMS, FIS, Oracle Cloud, PeopleSoft Treasury, and Treasury Advisory Services, where we do entire gap analysis and Treasury roadmap to advise our clients on what's the best TMS to choose, the best ERP to choose, and for change management and such, we have advisory services. So advisory services, we have application roadmap, training and change management. So for example, if there was an acquisition or change management, AP automation to automate your invoices, right? AP automation, take those payments on time, and project management. So we have a PMO team dedicated to this advisory services practice. In addition to that, we do managed services for Oracle and PeopleSoft and Kyriba. What this is managed services that we offer support post-implementation. So after the implementation is successfully completed and live is signed off, we offer support for, let's say, day-to-day support. In addition to day-to-day support, we offer implementation support. Let's say we want to add a new bank, new payments, want to add in-house banking, want to add risk module, fraud module, we can do that for you with the managed services contracts. Okay, so this slide is showing again the treasury service that we provide, because I'm in the treasury side of the practice. So Oracle Cloud, FIS, Kyriba, Treasury Advisory, on-prem, and managed services. Okay. I also want to say that we are a Swift Ready consultant partner, and all of our consultants are certified. We'll go to the next slide. So here is a few of a sampling of our valued clients, and we value our clients very much, right? And we're very proud for the work that we've done with them. And when we receive the client satisfaction surveys back, it shows, so very high client satisfaction, as well as you have existing relationship with them. For example, with the managed services, ongoing relationships with them to improve their treasury overall, and not just treasury, since I mentioned that Elire does more than treasury, so an overall, right? So advisory and whatnot. So we appreciate their continued business. Okay, without further ado, what is in-house banking? So I know some of you might know what in-house banking is. Some of you might implement in-house banking, and some might not have implemented in-house banking before. Okay, so a general idea of what in-house banking is, right? It's a centralized function in which the treasury team, so your team, right, becomes the primary provider for the banking services, okay, for the organizations operating entities, right? So think of it this way, to simplify it. Banks, right, are banks, right? You have a bank, general bank account, DDA account. When you have an in-house bank, right, you have a bank inside your corporation, right? In-house bank that can provide many of the services that the bank can provide in-house. Okay. And furthermore, to define in-house banking, it's a centralized system, right, within an organization that offers services comparable to an external bank, right? It provides the entities in your organization with an array of automated treasury services that facilitate traditional banking needs, right? And why does that help? Because it streamlines and standardizes treasury operations, right? It enables your organization to easily track incoming and outgoing transactions through optimized payments and account management. Okay. In addition to that, in-house bank provides internal participants. So internal participants means your companies, your subsidiaries, right? With financial, technological, and operational resources, including payment and collections activities, right? In addition to that, liquidity management, so for deal capture, debt instruments, accounting, so cash accounting, GLREC, FX, and service funding request. The FX just says FX trading, right? FX trading, FX payments. So when implemented correctly, in-house bank provides organizations with benefits and cash flow visibility. You get full cash visibility on your entire corporation, entire company. Okay. Risk management, you mitigate in risk by not having to go to the outside, right? Intercompany loans, which I'm going to explain in later slides how beneficial that is, right? Intercompany loans instead of external loans, and bank independence, right? So no worries about bank freezes or bank issues, your bank independence. This all drastically improves operation and provides you with a true return on investment. Okay. So in-house banking defined. What we explain in-house banking, a definition of it, but how is it defined? Like what does it entail, right? What does it entail? So first thing I want to say is that in-house bank supports organizations of any size, right? No size too small, right? Any size, okay? Any size and any geographical reach. Why? Because with the functions available, right, it can facilitate foreign exchange transactions, hedging, and interest rate calculations, right? In addition to that, the in-house banks, right, yes, they're critical processes, systems that require strong controls to manage operational risks. However, those managed operational risks are included, the mitigation of those risks are included with what? With the in-house banking, when, at least when you're doing it with a TMS, or implemented with a TMS, right? Because the in-house banking facilitates strong controls to manage operational risk through utilizing things like regional treasury centers, right, internal accounts, nominal cash pooling, multilateral netting, and payments on behalf of receivables on behalf of entities. And we're going to go over that in a few slides. So in-house bank, what does it do? It facilitates all of that through utilizing either a regional treasury center, internal accounts, nominal cash pooling, again, multilateral netting, or POBO, ROBO, payments on behalf of or receivables on behalf of. Okay. So treasury management solution, right? Treasury TMS, treasury management system, provides processing solutions that can help organize and manage various in-house banking activities. What I mean by this is that a TMS, any TMS we implemented, right? For example, VivoSoft or Kariba, they have a TMS, they have a in-house banking module that is almost plug and play. You enter in the information, enter in the account information, set up the account structure, right? And you're ready to go. It puts all of the controls in place already for you. And this is just to give you a general idea here on this slide, on this graphic, of what the services provided in in-house banking are. Okay, and there's not all of the services, only some of the services. So we're going to talk about the benefit of in-house banking, but first, let's go to a poll question.
Thank you, Abdel. Get this up here. Okay, so our first question, just kind of taking a gauge for the room again here. So does your organization currently use an in-house bank? Pretty easy, a yes, a no, no, but we're looking into it, or maybe you're just here because you want to learn about it, but it really doesn't apply to your organization. Give everyone just a couple seconds to answer. And again, from those responses today, we'll be drawing for $5 Starbucks gift cards. We'll give everyone just a couple more seconds here, get those last responses in. Okay, so it looks like we have a pretty even split, actually. Looks like we've got about 45% of attendees who are currently using an in-house bank, maybe here to get some pointers on how to optimize. 45% that are not, and looks like a little bit that not quite applicable, but maybe just here for the learning. Back to you, Abdel.
Okay. It's like a perfect split there, 45-45. Okay. Cool. No, it's good to see that folks are using in-house banking, right? Because of the benefits of it that we're going to talk about next, right? And for those that are not using in-house banking, you can see we'll talk about the benefits. So benefits of in-house banking. What are some of the benefits of in-house banking, right? So this slide shows cash visibility, lower fraud risk, automated workflows, bank independence, currency risk management, and centralized cash liquidity. Okay. So as you can see from the get-go, an in-house bank provides a wide array of benefits. Okay. It will definitely increase your cash flow efficiency and visibility because it centralizes your cash management for different entities, right? Allowing your organization to do what? To better manage the account. So everything's transparent for you in a cash position worksheet, for example. Okay. On top of that, you're using internal transactions, payments, and account statements for bookkeeping centrally. Everything's reconciled, right? So it gives you a real-time update on your reporting. So real-time reporting and tracking. And one of the things I love about in-house banking is that it eliminates manual workflows, right? So, and that's the most time-consuming pain point with most of the clients I've worked with in the past that we mitigated for them is manual workflows. Okay. So typing in transactions into the GL system and receiving the BAI and reconciling the BAI manually. And with in-house banking, you eliminate that, right? Because you have automatic processing like bookkeeping, month-to-month and closing routines, cash sweeps and flows, automatic, and notification management. So you set it and forget it. You set the lender balance in terms, you set the terms in the TMS, and it automatically, the workflow is all automatic for you, all automatic. Yes, you can set it up for approval if need be, because you can set approval on in-house banking transactions, but it's, other than that, it's automated. Okay. Lower risk of fraud, because we know for a fact that manual entry, manual workflow, anything manual has an increased risk of what? Of error, right? So when we're talking about fraud here, we have to encompass also error, right? So anything that's out of the ordinary. So reduce risk of fraud. Reduce risk of fraud because you're not going out to the external bank accounts. Everything is being managed internally. Okay. Another great thing is, of course, since it's automated, employees spend so much less time, right, on manual inputs and outputs, where they can focus their time in providing value-added activities, right? Uh, they can go in and decide, help the treasurer decide, for example, whether to use these funds for a money market fund or open up a new credit line or investments and so on and so forth, right? Or they can be looking at the bank variances, right? Uh, there's always something else to do, right? As a worker in treasury in the company, there's always something else to do. So the things that cause pain points, right, that are just redundant, like managing in-house banking, definitely something you want to consider over a TMS, right? Another thing with in-house banking and the risk management is it helps mitigate currency risk. Okay. How does it do that? It provides the treasury team with a clear view of the currency exposure and positions, which what allows the treasury team to take the necessary actions to hedge FX risk, right? So it gives you a full picture into what? Into your currency exposure positions, and you can utilize, for example, the in-house banking module along with something like the hedge accounting module to run the hedge risk and generate entries, hedge account and entries to your ERP. And then also, what does it do? It replaces numerous external bank accounts. So you're replacing your external bank accounts with internal in-house bank accounts. And this allows more control over your operations while keeping a close eye on your payments, transactions, and payment abuse, obviously, reducing fraud, reducing the risk for fraud, and of course, reducing costs. So that's what benefits of in-house banking. Now, what does it look like? So we have in-house bank organizational structure. Okay. So this table that you're looking at, it outlines how in-house banks can add value to existing treasury operations for each level within an organization. For example, regional level, corporate, and international level. And most organizations, right? Well, in-house banking can support most aspects of an organization and its subsidiaries that impact treasury operations, period, right? Whether regional, corporate, or international. So on a regional level, right, you can establish where the treasury team monitors their in-country cash and liquidity positions. Subsidiaries operating in that region, right, can have access to automated payments on behalf of operations that will streamline payment processing and provide for easy reporting for accounting purposes. Because every country had its own rules and regulations. Every country might have its own currency, right? Its own culture way of doing something. So with regional structured in-house banking structures, right, you're able to utilize the benefits of the locale. And we'll talk a little bit about that later too. On a corporate level, in-house banking provides organizations with efficient global cash management, because you get a full view of your cash management and all your banking relationships. And it even helps you helps you decide which one of your banking relationship is the best relationship and the relationship you want to maintain, right? And that's something that I always say to my clients. I say once you implement in-house banking, you'll realize which banking partners that you want to keep and which banking partners you don't need, basically, right? You can save lots of money on the ROI. So on international level, right? In-house banking, what does it do? Enables organizations to utilize notional pooling, right? Notional pooling structure and multilateral netting architecture. And this has built-in what? Built-in centralized liquidity and investment management. Because when you're doing that, when you're doing notional pooling, right, and multilateral netting, built into that is centralized liquidity and investment management, right? Cash forecasting, foreign exchange management, and hedging functions can all be monitored, right, by the treasury team that's managing the in-house banking. Okay. We're going to talk a little bit about the functions, right? Because we threw out a lot of different sayings here, regional treasury center. So what is a regional treasury center? What is it? When you talk about in-house bank, what is a regional treasury center? Why implement that and how to implement it? Okay. So regional treasury center, I just wanted you to look at this slide here. We have location incentive, banking support technology, infrastructure, operational support, qualitative analysis, and quantitative analysis. Okay. First thing you want to think about is that it can be challenging. It can be challenging, right, for treasury teams and international organization to effectively manage operations in each country that they're conducting business, right? Because each, like I said before, each country has its own set of rules, regulations, currencies, and cultures. Okay. So how can a regional treasury center help with this? If we look at location incentives, right? The location incentives, of course, you can get the location incentives because you're at the locale, right? So you're getting the dollar for dollar, currency for currency, currency for currency. You're getting the banking support, right? Banking support because the regional center can speak the language, right? And knows the process with the banking partners, banking support, and the banks there in the region, right? Technology infrastructure. You can't tell me that when you travel to different countries, they don't have different technologies. Definitely do. Banks in different countries, even treasury systems that are the same company look a little bit different, right? Where for other countries. So using that regional can offer you technological infrastructure, ease of use, right? Operational support, you'll have your support team there that understands the problem and can assist with that. And you can use the data that's received locally, right, to do qualitative and quantitative analysis versus the corporate, right, or the corporate. If we had a corporate regional center instead of a corporate center instead of a regional center, they won't be able to do that in-depth qualitative and quantitative analysis because they're not in the in they're not in there. Okay. So let me explain this. I'm gonna call our regional treasury center RTC. So each RTC works to connect customer and banking partner in foreign countries where complex regulations and unique cultures require what? Local employment, right? So treasury teams that work within RTC are going to have greater control in creating and enforcing organizational norms across the subsidiary, right? An RTC enhances operational efficiency. It standardizes the process for straight-through processing across regional subsidiaries. So it will reduce costs associated with having accounts in multiple banks across various locations and support bank account rationalization efforts with the entire organization. In addition to that, this rationalization can drastically increase cash visibility, forecasting, working capital, liquidity, resulting in what? Higher yields of available funds. And this ROI is seen almost immediately after a company switches over to in-house banking structure. Now let's talk about in-house banking structure that counts. What does it look like? So here we have regional treasury center, and then we have in-house bank accounts, and then we have under it external accounts. Okay, so what in-house banking seeks to do is replace the external accounts at the bank held by the organizations by internal accounts, right? Replacing them by internal accounts that do the same function, the same exact function as what the external accounts. These accounts can carry a negative negative or positive balance, and are what are primarily used to capture intercompany activity. So they're specific to in-house banking activity. Okay. Additionally, the internal account functions with direction from the in-house bank can support internally multi-currency accounts. So no need for all these FX exchanges with external accounts. So it can support what? Multi-currency accounts. It automatically applies the exchange rates and debits the central in-house bank while simultaneously doing what? Generating credit to the subsidiary account. So think about how much on exchange rates you'll be saving there. And then the in-house bank, of course, publishes on a monthly basis statements provided in the organization with visibility into the intercompany activity. And I'm going to explain why this is very important to review the activity of the in-house banking accounts, because there are tax implications and there are things that you need to be aware of that I'll explain in a minute. So at the beginning, like at the start of transitioning over to in-house bank, you can start with having an internal in-house bank account to an external account, having a one-to-one relationship, right? Prior to bank rationalization, just to ensure that all activity is captured properly, right, without interruption. You can make sure, okay, yep, everything's coming in, everything's working in the in-house bank as is working in the external bank. Once that's done, once nationalization is established, right, you can adjust the intercompany activity and have the in-house banking execute all the internal funding transactions through what? Through the internal multi-currency account. So no need for the external account anymore. And this is best practice because it's kind of like you want to test parallel testing, then transition over for the in-house banking. So that was talking about accounts there. What about moving the funds? So we're going to talk about nominal pooling here. So nominal pooling is very similar to notional pooling. And most of you might already know what notional pooling is the movement of funds, of intercompany funds, without the actual physical movement of the funds, right? It's notional. So it's not, the funds aren't really moving. Right, but there are banks offer the service and they do charge debit interest for it, right? So for example, here you see on the slide, you see sum of funds without and sum of funds with, right? So with nominal pooling, okay? Nominal pooling offers lots of benefits. Nominal pooling is slowly replacing notional pooling, okay? And nominal pooling is similar to notional pooling because funds, no physical movement of funds is made, okay? So just again, notional pooling is a service that's provided by the banks, okay? Nominal pooling is taken over notional pooling. More and more companies are moving over to nominal pooling because the costs associated with the long-term and short-term fluctuations can be avoided. Positive balances can move to offset negative balance, resulting in more efficient cash utilization. And instead of engaging with the external bank to support pooling efforts, right, which banks charge for, right, even though there's no physical movement of money, banks still charge for that, for the notional pooling. In-house bank provides nominal pooling as an alternative. All the benefits and functions of notional pooling, right, are provided in the in-house banking using nominal pooling. So as a result, what do you have as a result of that? You have a single liquidity position and managed internally with the elimination of debt interest. No more debt interest. Additionally, nominal pooling, naturally, because of the way it's set up, right, it for any time funds are being transferred to nominal pooling, nominal pooling, the natural net in process of intercompany AP and AR activity, automation of the clearing of automates the clearing of inter-entity or intercompany non-physical cash flows. So all of that activity is automatically posted to the GL for what? For the GL record for the book of records. It's all automated. But something to keep in mind is nominal pooling structures. They're traditionally usually set up with the major currencies, right? And when we say major currency, what do we mean? USD, Euro, GBP, and CAD. Okay, they're set up with these major currencies. Now, why? Why again nominal pooling? Because this significantly reduces all daily physical cash movement and associated fees. And I know you might say to yourself, like, oh, fees, I'm not being charged that many fees. I'm being charged just a little bit, a cents for the ACH or a couple of dollars for the wires, right? But what if we're doing 100 wires, 1,000 wires, and then you look at your bank fee analysis statement at the end of the month, your EDI 22 or twist file or KMT 54, and you're like, whoa, all of this for transfers? Yes, it adds up. It adds up. So there's no physical movement of funds. So all the associated fees, there's no associated fees then. Okay. In addition to that, with implementing nominal pooling with TMS, you provided a nominal daily cash position that reflects physical cash needs of the pool participants. So it's going to show you all the participants in your cash in nominal pooling, and it's going to show you the needs of each one. So you're aware of how each one is doing, number one, and who needs what and how much. Okay. In addition to that, Treasury teams can track all NDFs, so non-deliverable functional currency positions with nominal pooling. And then finally, I want to say with nominal pooling is that any FX trading for funding purposes that is performed at the aggregated in-house pool level, right? Of course, taking into consideration some of the regulations, right? But any FX trading for funding purposes that is performed in the aggregated in-house bank and not the external trading platform gets a much higher rate of return, right? I just want to say again, there are some regulations and restrictions may be in place depending on the organization is located, depending on location. But for some locations, for example, Italy. In Italy, they require organizations to disallow debt positions. And in Poland, for example, they have they need a complex tracking system like first in, first out. So you have to think about if you want to set up the nominal pooling, where you want to set it up. So moving on, another type of in-house banking function is multilateral netting. What is multilateral netting? And this too, multilateral netting can be set up in the TMS. Okay. So on the left side, we see without multilateral netting, we see arrows going everywhere. It's going from each one of the subsidiaries or companies, right, within the organization. And then with multilateral netting, we see one central hub, the netting hub, and the subsidiaries companies are connected to the netting hub. So there's one way of doing it, multilateral netting. And it does minimize costs because you are going from transferring all of these transfers that you see on the left, right? To only a few transfers every time you need to make a transaction. So you're netting all of the amounts together, and what you're doing is that you're using a large volume of you're no longer using a large volume of cross-currency transactions. You're using just one single transaction. So the infrastructure of in-house banking allows for automated multilateral netting that it minimizes the amount of transactions significantly, because what? And I'm going to explain why in a minute. So instead of dealing directly with one another, like on the left side, the company's subsidiaries, they inform the netting hub, right, of all planned cross-currency payments. So A, B, C, D, E, F, they let them know, okay, here are the payments I need to make. Here are the cross-currency payments I need to make. So each entity's transactions from the netted hub will be aggregated into a single local currency amount that will either be paid or received from the in-house bank. So single currency amount paid or received from the netting hub. And why is that beneficial? Single transaction, one transaction versus 50, right? One transaction versus 50. And with that one transaction in the local currency, no FX rate conversion costs. So having multilateral netting structure in place, it provides a standardized structure to all intercompany transactions. So you see everything through the netting hub, right? Since fewer payments are being made, there's a reduction in associated payment costs, and there's a reduction in what? In the number of banks for managing payments, right? Because each one of these subsidiaries or organizations in your company can have their different bank accounts, right? So instead of sending the funds or receiving the funds from that specific bank account, no, all of that is netted through the netting hub, and the netting hub works with only one bank. And that goes, and so I was saying before, you when I implement this for our clients, they think about, why do I need this and this bank anymore when I have the in-house bank and I can save so much more money. Okay. So another benefit is the inherent risk of in counterparty obligations, right, is going to be reduced because you have the credit settlement, liquidity, and systematic risk are all mitigated through this process. Okay, so next we're going to talk about HOBO and ROBO. Payments on behalf of and receivables on behalf of or collections on behalf of. Good. So one way in-house bank can optimize treasury operations is to implement POBO, right? Again, payments on behalf of, and or receivables on behalf of, which is also called collections on behalf of structure, right? What does this do? This structure allows in-house bank to centralize and automate the payments for several of the group's entities through a regional treasury center or a shared service center. Okay. The in-house bank directs payments to the bank of choice, right? To obtain favorable processing costs, allowing for negotiation of financial terms, right? And what does this do? It simplifies an organization's network arrangement and streamlines operational processes. So you've seen here in the graphic, payments on behalf of, for example, payments on behalf of. So the in-house bank receives instructions from the subsidiaries, right? And instructions, and it's we need to send a specific currency amount, right, to the beneficiary, the third party. Okay. And since the in-house bank, we know that all these companies can or subsidiaries can have different banks. So we see which bank is most favorable with the exchange rate, and then we utilize that for the bank that's most favorable with the exchange rate. That transaction added to another transaction can add up to thousands and maybe even the millions later. Okay. So it's kind of a smart routing of payments type of thing. Okay. And of course, having the in-house banking structure do that for you in POBO and ROBO, it improves cash visibility, improves cash reconciliation, right? Cash concentration, and reduces the inherent costs associated with payment execution. Okay. So having the POBO and ROBO in place offers improved risk management opportunities by considering banking relationships and centralized controls, right? By consolidating banking relationships. Consolidating banking relationships, because you have the relationships of these banks, so of these subsidiaries banks. So consolidating bank relationship and centralizing controls. So you get to pick and choose which one is going to give you the best rate. Okay. And how do you start with this? Is it easy? It's super easy, right? So the process begins with either a supplier invoices a subsidiary, or when a subsidiary or company invoices a customer. It triggers the in-house banking to kick off, right? And the automated process, the TMS the process runs and checks payments rates and sends a payment, posts a confirmed forecast, updates the cash position worksheet, and reconciles with what? with the actual the next day or the intraday file. So just to summarize, POBO, payments on behalf of, intelligent, cost-effective, and efficient payment routing. Okay, so fewer bank accounts because you're consolidating all those payments into one payment, and receivables on behalf of or collections on behalf of RoboCobo, centralized collection. Okay, the centralized collection, fewer is also in turn fewer bank accounts. So you're receiving all the funds from one account, right? From one account to the bank, and then dispersing it basically to the subsidiaries. So less physical accounts needed, or less costs per month for the accounts. Now, I talked a lot about benefits, right? And there's a lot more benefits that I like to talk about, but I just summarized and I did high level for the most important features to get you started or get you thinking about in-house banking, or if you already have in-house banking, to get you thinking about the processes that you're doing. But here's some considerations, right, that and I need you to think about as a treasurer, right? So first, you have to think about your bank account structure, right? You have to think about your current bank account structure. You got to think about the resource requirements, the netting account structure that you want, right? Because we talked about different netting structures, the policy changes that needs to be put in place, and again, the location, right? So before deciding to implement in-house banking, you need to spend some time researching and considering the pros and cons, right? Like anything. So you need maybe some advisory, right? And that's something we offer advisory. If you wanted someone else, someone to do it for you, the advisory services. But if you want to do it yourself, that's completely fine too, right? So you may need to reevaluate your existing policies or create new ones depending on the functionality, right? That you have that you want to deploy, right? And then you might have to revise internal agreements, right? To define minimum operating cash amounts to enable cash sweeps and ZBA, right? So you have to discuss with the banks, right? On, hey, what's the minimum I can maintain in this account? What's the minimum? Can I sweep this account to zero, right? Because yes, in-house banking, you're working with all of those subsidiaries, right? But you have that one bank connected, physical bank, at least connected where to the actual bank, the external account. So I make sure that you can transfer funds there, and if the ZBA is possible and whatnot. And that's the type of pooling for you that don't know that zero balance accounts is that accounts are swept to zero balance to what? To one central account. Another thing to consider is that every business unit, right, in the netting structure that you put in the netting structure is going to require review and pre-approval for all of the netting, right? So you want to consider that on how you're going to implement that, the approval and the review and approval. The TMS already has that set in for you. You just put the approvers, right, and approvers limits, and it's done and set. But if you're not working with a TMS, you might need to go out there and get some sort of user online interface to help you set that up, or some sort of cloud solution like a TMS, like I said. And then another thing to consider is to implement cash pooling, right? So cash sweeping and notional pooling, that's internal cash sweeping, right? So that's internal cash sweeping. You're sweeping cash, but not physically at the bank, you're sweeping internally. Organizations, right, you need to reevaluate and be prepared to overhaul their current bank account structure, right? Because once you start in-house banking, no need for the external account for that specific subsidiary anymore, right? So you close that account. So you want to consider the architecture there. Okay. Another thing to consider is when you're doing the regional treasury centers is time zones, right? So as accounts with deliverables, functional currency may not be included. So account with deliverable functional currency might not be included in the cash sweep due to the time zone discrepancy, right? Or the time zone discrepancy, yeah, so the account might not be included in the sweep to the time zone because it didn't post early enough or posted too late, right? But to prevent this, there are ways to prevent this, like setting up a sweep construct. You can install a sweep construct, and you can mitigate that risk there. So just to summarize, what you need to do first is you're looking into improving your in-house banking, improving in-house banking with a TMS, or setting up in-house banking for the first time. You need to define and dedicate resources for each function you wish to deploy, right? For example, organizations decide to implement RTC, okay, Regional Treasury Center. The satellite offices will be required to what? Sweep business unit bank accounts to 0. So you got to keep that in mind. Additionally, organizations, right, need to determine the best location for deploying in-house banking, because like I mentioned before, some countries have certain restrictions on in-house banking. And of course, tax and regulations will need to be considered as they impede daily operations. So for example, many locations withhold tax on bank interest, and other have high transfer pricing between bank accounts. Right? In addition to that, some locations have restrictions on the type of transactions that are permitted in house banking transaction, meaning, for example, payments on behalf of and receivables on behalf of operations might not be viable. So POBO and ROBO might not be viable, but multilateral netting or nominal pooling might be. You want to make sure in your region what's supported. Okay, region, not only your region, but regional your subsidiaries, if you're planning on implementing regional centers, regional treasury centers. So now we're going to go to a poll question. Exciting.
Thank you, Abdel. And as we're getting close to the end here, again, one final reminder that we'll be doing our gift card drawing after this. Which of these considerations is most likely to affect your decision to use an in-house bank or not? Needing to define and dedicate resources, determining the best locations, or taxes and regulations? And for that 45% of you who are utilizing an IHB, I would say which of these factors, I guess, was most important to you when you were considering? We'll give everybody just a minute to answer here. A couple quick housekeeping items while we're almost wrapping up. As a reminder, the links for the next 2 sessions will be put in the chat, including our next CTP session, which is Doing More with Less, Project Governance and Managed Services, that starts at 2. Okay, we're going to go ahead and close up this poll. So looks like kind of a mixed bag, I guess, around 58% saying the need to define and dedicate resources for each function, followed by taxes and regulations, and lastly, determining the best locations.
Very good.
Back to you, Del.
Very good. Very good. Yes. So that's important. With the resources, it's very important. And one thing I can say for sure is with the TMS, with a implementation team such as Elire or another partner, if you're implementing the in-house banking with TMS, we train the trainers for you to be fully independent. So your team would be fully independent after we train them on each aspect of the in-house banking structure that we're setting up. But let's talk about efficiency and risk mitigation. So how does in-house banking help us become efficient and mitigate risk, based on what we talked about? Okay, one of the most appealing features of in-house banking is the way it simplifies the process, right? Yes, at the start there is implementation costs involved, right? But once you get it implemented, it simplifies the entire process. Sit back and relax, right? So maximizing control over global cash flow. So having a central in-house bank leads to improved cash visibility. Not only does centralized cash account make funds management easier, right? It also generates better investment than having multiple subsidiary accounts. So having it centralized, it generates better investments. Providing better visibility and control over positions, right? So you see in real time your position, funding needs, FX, offering better use of internal balances. You don't want stale cash sitting down. You can see when you're doing in-house banking, I can move these funds from here to here and use those funds. Okay. Now, provide in-house banking services to all business users. Yes, if your company operates an in-house bank, right, it can transfer funds throughout its subsidiaries, no doubt about it. Okay, as necessary, and in-house organizations, right, your subsidiaries could qualify for what greater lines of credit than standalone subsidiaries, as if they were just applying themselves, right? So centralized cash management, the Treasury team can set their own borrowing and lending terms, right? So you can set your own borrowing and lending terms and rate on the intercompany transfers, okay? And you can apply them directly to the internal department, okay? So that's kind of awesome. And another thing is that it minimizes external borrowing, of course, because instead of each subsidiary applying for external loans or credit lines, they apply directly to a single internal department. And also, right, when you have in-house banking, the subsidiary has more chance of a higher credit line because the in-house bank account is the one that's applying for the credit line there. So you have high uh you have a higher higher chance of a higher credit line. And of course, cost efficiency, right? In-house banking mitigates fragmented FX, so fragmented FX, foreign exchange, resulting in more efficient FX operations and lower cost. So less trades equal what? More favorable bid-ask spreads. It's mathematics, right? So the return on that alone could be substantial. So in conclusion, because I know we're coming up on time, and it start with the in-house bank can accrue costs quickly during implementation. During implementation, it can accrue costs quickly. And I see that based on the survey results, yeah, there's concern about that. But once in-house bank functions are implemented correctly and automated through the TMS, organizations will immediately start to see their return on investment, and their team would be trained and fully independent on the in-house banking functions, right? So the value in in-house bank, the value of in-house bank can be measured by cost reduction immediately after, right? So it's going to see cost reduction, productivity gains, and financial and strategic benefits. And additionally, when organizations implement in-house banking, they see efficiencies in compliance, control, and fraud prevention, strong fraud prevention, right? On top of that, in-house banks allow organizations to improve their existing controls and introduce any additional compliance change controls that may be required for them to comply with internal policy or external regulations, right? Because automated in-house bank will reduce errors, increase fraud prevention by standardizing processes across all subsidiaries, and will provide numerous strategic benefits, including in-depth cash visibility, easy tracking and management of the system operating these automated functions, UTMS, and the increased visibility. What does that do? It opens the door for organizations to build additional strategies and tactics to run their operations more efficiently. Okay. And the most noticeable qualitative benefit that can be seen through reduction of manual workflows. Remember when I said manual workflows are as much as you can go to automated workflows. So the reduction, the most qualitative benefit that can be seen through the reduction of manual workflows. Understanding quantitative benefits of an in-house bank requires what? A deeper dive into current operations and proposed future operations. So a gap analysis, right? Current state, future state. Conducting a thorough cost-benefit analysis on implementing an in-house bank with a TMS will provide what? High-level insight. Well, for implemented in-house banking with or without a TMS. We're doing an advisory with that. We'll provide high-level insight on what's the estimated, what quantitative investment cost, and what some of the long-term benefits and savings will look like. So I want to do that. I would suggest you do that first. Yeah. So all in all, TMS can help you run an in-house bank with transparency and efficiency. Automation lets you schedule regular payments and fund transfers. Remember, you can set the auto balancing terms of getting automated. You receive the bank statements, you send the payments are posted, the GL is posted, everything's automated through the in-house banking structure and the TMS. So it allows you to schedule regular payments, funds transfers, and data analytic platforms can monitor the movement of funds. So you get increased visibility, saving money, and analytics show you where your organization stands and where you can improve. So that's the beauty
Hi,
of this.
Abdel. I gotta hop in here because we are gonna have to close out this session in order
Okay,
to
I'm
open up
done.
our next session,
Okay,
which starts in 2 minutes. The
all right.
links for those folks are in the webinar chat. I want to thank everyone for their time today on this session, and we hope to see you on our 2 p.m. sessions. Thank you very much, Abdel. Thanks, everyone.
Thanks, everyone. Appreciate your time.